to another Sip and Tip. As always, I am Paul Trogdon with Sweet Tea Realty, powered by Coldwell Banker, Seacoast Advantage, and the Paul Alsop Real Estate Group. And with me today, I have Mr. Joey Milam with Alpha Mortgage. Joey, thank you for joining me on the Tip and Sip today. And we're going to be discussing mortgage rates. Now, as of the recording today, we have not heard anything official, so we might do an addendum at the end of this Tip and Sip. But again, Joey is one of my guys. He's one of my main guys. If I have a question whenever it comes to mortgages and everything, I don't pretend to know. I'm a real estate agent. That's what I play on TV. And in real life, mortgage, this is the guy that I go to. So with that said, let's go ahead and just kind of jump into it. What are we seeing with mortgage rates right now? As of the recording today, we're in the month of April, so we're right before everything. What are we seeing right now?
Yeah, Paul, thanks for having me. And it's definitely been a couple years of interesting time, shall we say, in the mortgage world. But as of right now, when you and I are talking today, the Federal Reserve met just a couple weeks ago and have basically continued to indicate that for the near future, meaning their next meeting, which will be in about a month now, they probably will not have any change in the Federal Reserve rate. The Federal Reserve rate, the rate at which large institutions, banks can borrow money, in many ways sets the tone for what mortgage rates are.
Okay.
So the indications as of now are that there's a pretty good chance, the tracking system that we use says probably about a 68% chance that the Fed will do a small reduction of their rate probably in June. And then as time goes on throughout the year, we're expecting that to continue, hopefully. They've indicated there might be as many as 3 reductions this year. And as they reduce rates, we will likely see mortgage rates start to dip a little bit. Probably won't be a huge instantaneous drop in rates, but we do expect them to start to trend downward, hopefully, over the next few months. Normally, the mortgage market tends to try and anticipate what the Fed's doing.
Okay.
So there's a number of ways that the industry, certainly not me or any one person, but just as a whole, the industry looks at things like there's any number of key indicators, consumer price index, inflation numbers, and even the things that the board members, particularly Chairman Powell of the Fed, say in their speeches and talks and things like that they give. And so we really pay attention to that, and we try and anticipate what they're going to do and adjust mortgage rates as we get closer to their big decisions.
Now, so you kind of hit on with anticipation and everything. What kind of anticipation as far as the numbers, and you kind of alluded to it, so I would say, and correct me if I'm wrong, right now we're seeing about 6.5% to 7% overall.
It's probably one of the biggest questions I get asked is
it fluctuates.
What's the rate today? It can really be a huge variance depending on credit score, of course, down payment, what loan program you're doing. I have seen rates anywhere from the low 6s up into 8%, depending on what you're doing.
All right.
Occupancy plays a huge part of it. So, if I were to take probably the average rate right now out of all the various loan programs and all the loans that I do, it's probably still at around the 7% mark.
Okay, and that's fair. But with what they're seeing, so if we use 7%, knowing folks that I'm not going to hold Joey to that,
Please don't.
But if we look at it from some numbers, what kind of rate reduction are we looking at? We saw in the last 2 years of basically going from a 3 to 4% that people were paying all the way up to 8%. Now we're kind of back down to 7%. Are we seeing a percentage point? Are we looking at 7 to 6, 7 to 5, or are we looking at something more like a 0.5% or 1/4%?
Certainly no one, me least of all, has a crystal ball and knows exactly what's going to happen, as you said. But, I would say my gut feeling is that we'll probably see some fairly minor reductions as we go. So if we're, let's say, an average of 7, maybe come June we might be at 6.75. Maybe a little bit later in the year, 6.5%. Maybe down to 6.25 by end of the year. It may be even smaller reductions than that. Could be just an 1/8% reduction, 6.875 then 6.75. It's probably not going to be huge reductions. Over the next several years, though, this year, next year, and certainly we have an election coming up, that can play a part in it as well. But we're really hoping long term that we probably get back down into the 5s, I would say. We're probably never going to see, never see 2s again. That was just sort of a one-time fluke thing. Probably never 3s again would be my guess. Maybe in some government-type back loans, who knows. But if we could get back down to the 5s in the next few years, that's a good, normal average rate, really.
Okay.
It's really below average, in all fairness, over the history of mortgages. So,
well, that's been my understanding. 8%. If you're under 8%, you're golden. I mean, like 80s was like 15, 19,
22, 1%.
There you go. 8% don't sound too bad now, does it?
It's amazing to me anyone bought homes back then, quite frankly, at 20+%. But if you take out the 2020 and 2021, those 2%, 3% numbers, those were anomalies. If you take those out of the mix, then yeah, probably about 8% or so would be the average over the history of mortgages going back from maybe the late 70s, early 80s on. If you include those numbers, it goes down to probably closer to about where we're at now, 7, 7.5, I believe.
Okay.
And there's you could probably talk to 3 different people and they give you 3 different, slightly different numbers, but 7 to 8% is a pretty good average. I'd say we're kind of on the low end of it now, and I do think we'll go lower than that, certainly in the next couple of years.
So if we do hit that 5% within the next couple of years, that would be a good norm, but still historically low.
Absolutely. You know, I just had a conversation recently with a client. You know, a lot of people right now are looking at buying homes and probably expecting to refinance in the next couple of years. We don't expect home prices to go down, home values to go down. They're likely going to continue to increase. So, you know, a lot of people are just choosing to buy now, and we'll plan on refinancing when the rates do come down some. One thing I do stress to people, though, often too, is it's impossible to try and find the bottom of the market, the lowest possible rate. If you're holding out for that, you'll see it and then you'll miss it, because eventually they'll go back up a little bit too. That's just the natural progression of interest rates.
So, and that's one of the things that I usually say to my clients, and you know, I'll say this again, and since I have a mortgage person right beside of me, he can go, "No, Paul, you're lying," or "Yes, you're correct." So the old saying that I've been saying for about 2 years now is, marry the house, date the rate. So basically, get into the house now, and you know, and we've even seen some numbers. You know, Paul also put a thing up a little while ago that like back in the 70s, people were waiting. They really didn't see a rate increase or decrease until the 90s. But the same house that you could have bought in 1972 compared to 1992, the rates, you know, don't wait on the rate, basically. And I think, Joey, you were just kind of alluding to that from a thought process of, we're going to see housing market continue to go up, and again, hopefully not 20% year over year like we saw 21, 22, but I think a lot of that was also a correction from everything that happened back in 2007 to 2011. So I think I don't think we're going to see that kind of correction, but for the most part, historically, your house usually sees about a 3% increase, I would say. And so with that 3% increase, if you're waiting for the rate to just lower, what is half a point, and I might have you explain that here in a second, compared to saving $15,000, $20,000, $25,000 on a house. So the main thing that I think I can say with my tip, as Joey gives us some tips on the mortgage side, is if you find the right house, go ahead and buy it. We can always turn around and get you a different rate and refinance down the road. So that's my biggest tip, is if you're waiting on the rate, don't do that. Let's get it in. So one of the things I kind of alluded to, and if you would explain points. So you kind of hear some stuff, and with my other mortgage guy, we kind of talked about that a little bit. That was 2 months ago, go check out Zach. He's a good guy also. But so tell me what is a point and how does that help from a standpoint of what I was just kind of discussing as far as percentages?
Yeah, absolutely. Discount points are essentially a one-time fee you can pay when you go to closing. It's considered a closing cost that will reduce your interest rate for the life of the loan. Now there's, and I will say this is probably one of the most confusing things often, that it's definitely in the top 3 of things that I explain to clients when I'm talking to them. So a discount point, 1 point equals 1% of the loan amount. It does not equal 1% difference in interest rate. The distinction is points are the cost of buying down the interest rate. It's not, doesn't equal necessarily to the exact amount of the rate. So just as an example, if you're buying a home and you're getting a $100,000 loan on it, if you were to pay 1 point to get your rate lower, that 1 point would cost you $1,000, 1% of the loan amount. What it does not mean is that you get a 1% lower interest rate. Let's just say your interest rate's the average, about 7% or so right now.
Okay.
And you're doing this $100,000 loan and speaking with your lender, and we tell you we could buy your rate down 1 point if you wanted to. Oh, okay. What does that mean rate-wise? It changes every day. It fluctuates with the market, and it's not even a set scale. So today, 1 point might buy your interest rate down from 7 to 6.75%. Tomorrow, it might buy it down to 6.5%. Again, really varies depending on the loan amount, the loan program, any number of different factors. But essentially, that's all it is. One thing to point out, when you pay interest points, in most cases, they are tax deductible, just like your interest that you pay on your mortgage every year over year.
Good tip right there.
Now, one thing I will say though too, and it's always kind of a juggling act, and ultimately it is up to the client what they want to do, of course. But one of the things that I do bring up to clients is if you're going to be refinancing, if we think right now, again, no crystal ball, no guarantees, but we do think rates are going to come down, hopefully a fairly significant amount. Hopefully if their average is 7, it would be wonderful if we can get down into 5. If the thought process is you're going to refinance within the next couple of years, it may not be worth it to buy the points down depending on what the cost is. So just as an example, if you're doing say a $500,000 loan and we tell you, well, you can buy your rate down 1%, it's going to cost you 2 points. That's $10,000. It's a lot of money. Now, some people might say, well, yeah, but it's going to get me a payment that's $100 lower. All right, well, if you take into account what that monthly savings is versus what the cost of buying it down is, there's sort of a return on investment period there. You divide that out by months and we say, all right, here's how many months it's going to take for you to recoup that investment that you spent on points. Well, if you're going to be refinancing next year though, you're going to pay closing costs again, and those points would have been somewhat wasted. So it's always sort of a strategy we want to discuss and see, is it wise to pay down and to pay points? Many times it is, but not always.
No, that's a very good point. And again, it makes sense from a standpoint of where things are sitting right now. Because 10 years ago, whenever I bought my house, I do believe that I did pay some points, and here I am 10 years later. Obviously, I did a good thing, you know. And so, if I was to sell my house today or whatnot, I've recouped more than likely from that standpoint.
Oh yeah, definitely.
This crystal ball that you keep saying that you don't have, if we look into it, and I know that we've kind of hit on it right now, what is the thought process of seeing rates go up? I know, obviously we didn't want it to go up to 8%, and we kind of, top end out at that. But do we see any chance? And again, I know you're going to say you don't have the crystal ball, and we want to see things coming back down to 5%. But with inflation doing what it's doing right now here in 2024, and taking all that into account, and again, I think you kind of already hit on this, but I just want to reiterate, where are we seeing the percentages going? Is there a thought process of it going any higher? You know, I mean, again, marry the house, date the rate. There's a chance of this and that, but you know, I just want to make sure that people know the old adage: when's the best time to buy a house? Yesterday. You know, but so do we see it going up, or do we see it staying the same? And again, with your non-crystal ball, what do we got?
Well, first of all, if I had the crystal ball, I'd be buying a Powerball ticket. I think it's up to about $1 billion now, so we wouldn't be sitting here discussing it. But you know, will rates go up? Absolutely, at some point, of course. It's just, again, natural progression of the markets. They go up, they go down over long periods of time. In the short term, you know, right now, the next couple of years, there's not really any. I do not see any indication that rates will go up.
Okay.
And any significant amount. So if we're at 7 now, are they going to be back at 8? I don't think so.
Okay.
Could I be wrong? Absolutely. Again, this is an election year. There's a lot of different factors.
Craziness.
Yeah, there's so much craziness with that, with markets, with inflation numbers, world events, things that are certainly out of our control and really out of just about anyone's control.
Yeah, unfortunately, Taiwan and
yeah,
what just happened there.
There's so many things going on in the world right now, and you know, world economies and markets really do. We're so intertied to the rest of the world as everyone else is. It has a massive effect. You know, at some point, yeah, of course, rates will go back up, but we don't expect them to. The good thing in an election year is that traditionally, rates do trend downward. Either side of the aisle, no one wants rates high when they're trying to get elected or re-elect the president, but or in office in general. But no, we don't really see them likely going back up.
Right.
And I think that many of us in the industry, again, if we could get down in the 5, the 5s would just be awesome. If we could get there and stay there for as long as possible, but no indicators of increases.
All right, sounds good, sounds good. And then one of the things that I always like to do is just, you know, not necessarily trying to put you on the spot, but I'm going to put you on the spot. If there was anything for my audience, tip-wise, that you are discussing with your clients right now that we might not have hit on, doesn't even have to necessarily be with rates or anything like that, but just what you're seeing, you know, as, you know, one of the top brokers with Alpha Mortgage. All right. Is there anything that you could share that would just be a great, my goodness, I didn't know that, and now they can, you know, seem smarter than what they are at parties?
You know, I mean, a lot of what I've said, there's a great website out there called FedWatch that I keep track of, that many of us in the industry do, that kind of tracks these numbers as far as what the Fed's likely to do. And I will say, it probably, watching it probably makes me sound smarter than I am, more knowledgeable than I am necessarily. But you know, I mean, just sort of general tips for anyone that might be in the market to buy a house. I would say, really know and pay attention to your credit. Things out there like Credit Karma and even the Experian monitoring services, all these things that will tell you your score. That's probably one of the biggest surprises I think that clients get when I'm speaking with them, is probably 90% of clients, when I go to pull their credit score, it's probably anywhere from 20 to sometimes 40 points lower than what they think it is. Only because there's different credit scoring models out there.
Yeah.
Mortgages, needless to say, use very conservative ones. And you know, Credit Karma and my score are going to be two totally separate things. Vastly, mine's going to be lower. And again, it's just a matter of different types of credit scoring. I think, you know, one of the biggest things that too, a lot of times people with credit kind of have questions about is, you know, what can I do to increase my credit, or how do I even find out? The good thing is we can do a quick soft pull on someone's credit. It doesn't show up as a hard inquiry. It tells me a person's basically everything that's on a hard inquiry. Doesn't hit you, doesn't, you know, ding you for any points.
And let me pause you right there for a second, just from the standpoint of, and whenever Joey says it will be a soft pull, it will be a soft pull.
Yes.
It's not like going to a car dealership going, no, this won't ding your credit at all, and then you're sitting there with the salesperson and you get the email going, you've had a hard pull. It's like, I was just told it wasn't. No, Joey's not lying about that.
And that is something, if you are buying a car, this is nothing against car dealerships whatsoever, but the amount of times that I do see sometimes that people will go to, you know, probably some of the not so big dealerships and, you know, apply, and I'll see boom, 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 just all these inquiries all on the same day from a bunch of investors and car lenders, because they'll send it out to every lender that they've got at that they work with to see who will give them the, you know, the car loan. The good thing is when you do get a hard inquiry for mortgage, you've got a period of time that you can have a few other hard inquiries and it's not going to ding your credit again.
Okay.
That's really probably one of the biggest fears people have. I don't want to have my credit pulled. It usually is going to have a very, very minor effect on your score, if any, sometimes. But just knowing what your credit score is, knowing what you can do to increase it if possible, if it needs to be increased or work on it, is very valuable. Like I said, it's totally free. You call us up. Hey, I'd like to know what my credit is. I'm thinking about buying a house. You know, I can pull someone's credit in 5 minutes. They give me name, date of birth, social, and address is basically what we need. And once I have that, I can tell you, here's, you know, what your scores are. 800 credit scores and hardly any debt, great, you're golden, you're good to go. You know, you've got a 600 credit score and, you know, maybe a couple negative, what we would call derogatory marks on there, a couple dings on your credit, we might be able to help you with it. There's certain things you can do, you know, keeping your credit utilization of credit cards. If at all possible, everyone should always try and keep their balance on their credit card at less than 30% or less, what the limit is. Having a maxed out credit card or one that's over the limit, that'll hit you for some points. Nothing's worse than late payments, of course. That's just going to ding you 50 points or more in some cases. But keeping your credit utilization down, obviously trying to avoid collections, things like that. One of the most common things I see is probably medical collections. That's something in the mortgage industry we don't, other than how it affects your score, we don't generally care about.
Okay.
Medical collection's not something that's not a bad decision someone made. That's just they had to go to the doctor and maybe didn't have insurance or coverage or whatever. But that is typically one of the only collections that you can actually call up, pay off, and say, I would like to have this deleted. And they'll actually delete it from your credit. In many cases, not always. There's a few out there, a few sticklers, credit agencies that, or collection agencies that won't do it, but most of the time, pay it off, it gets deleted, it's like it was never there.
Nice.
Yeah.
That's a very good tip, and I'll say this from a personal standpoint. Most of y'all know that you know, I went through colon cancer last year, and you know, bills have racked up and whatnot, and you know, just kind of knowing this information is good to know, you know, from that standpoint.
Yeah, you know, it's also a matter too of a lot of times there'll be collections or little dings, late payments, what have you, that people don't even know about. I had a client a few years ago who he and his wife, one had I think 800 credit scores, the other had high 600s. They were absolutely shocked when I told them that. They both had excellent credit their whole lives, and come to find out there was a $20 medical collection on the wife's account, and it was hitting her for a bunch of points. It was fairly recent, so it was new. It was, you know, really affecting her credit. And they were just absolutely shocked and found out that it was whatever. This was not someone who couldn't afford to pay a $20 collection. And still not entirely sure, I think, what happened, but I told them, call this number, tell them you'll pay it off, ask for a deletion letter, credit jump right back up to in line with her husband's at 800s within, we were able to do what's called a rapid rescore, get it done before they closed on the new house, and it affected their interest rate fairly significantly. They got a much better interest rate because we got both of their credits up.
Nice.
It's another thing a lot of people ask about is, you know, maybe someone who has lower credit and say, well, I've got someone that will co-sign for me. A cosigner does not help when it comes to credit. Co-signing only helps when it comes to income. So with credit, and this is how every mortgage company in this country, to my knowledge, looks at credit. We look at all three credit scores from all three of the big bureaus, Experian, TransUnion, and Equifax, from all of the borrowers. Every borrower that's involved, I've had as many as 5 on one loan. We look at every single person, we look at their middle score of the 3. Whoever has the lowest score, that's the one we use. That's what we qualify based on, that's what their interest rate is going to be based on, everything. So adding someone who maybe has better credit is not going to help you. If you need a little bit of extra income to help qualify, CoSigner might help you.
All right. Man, that's another great tip. I never even realized that. And I didn't even know about, taking the middle score out of everything. So, boy, I think I might take the next couple months off with tips and sips with how many tips that we're getting in this one. Thank you, Joey.
Very well.
So with that said, guys, there's a lot to chew on this, and for you guys to kind of go back through, and I might even break some of this stuff up and throw it up as shorts and whatnot, because this is some great tips. So again, thank you for joining me today.
Thank you for having me.
For the tip and sip, and for all your mortgage needs and everything. Joey Milam with Alpha Mortgage, we'll be able to take care of you. And again, as you guys know, if I'm not able to help you from a standpoint of you're just looking to refinance, that doesn't have to deal with me, and that's okay. I'm here to help you as a friend, family, client, neighbor. That's my job, is to help you, whether it helps me in business or not. So if you have any questions or anything like that, Joey is one of the guys that, like I said, that I go to all the time, ask the questions, get the right answers, and that's also a big thing, is to get the right answers. Yeah. But anyway, with that said, folks, we're on the front porch as always. So hopefully you heard everything. We had some cars going back and forth, but you know me, I like to sit on the front porch, because at the end of the day, we want you sitting on your front porch sipping sweet tea. With that said, God bless.